Hello, I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our regular collection of financial perspectives for the week ended Friday, August 21st. Times continue to be historically challenging, and they can be hard for investors to navigate on their own. So we just want you to know that we at Foster Group are here to help. We love to help our clients. We have over 1,400 who we truly care for. We help them to plan, to prepare, to protect, invest, and give. And we would love to have that conversation with you as well. At the end of this presentation, there'll be some contact information where you can contact us if you'd like to. Let's take a look at what happened in the news in the last couple of weeks. We've had the first week of what will be 2 weeks of political party virtual conventions kicking off. The Democrats had theirs last week. They're a little different than normal political conventions. Instead of in big arenas with thousands of people dressed strangely, these are going to be more virtual planned events, but they will kick off the election season in earnest, and there'll be lots of news around that economically. Broad measures of U.S. large company stocks, they climbed above pre-COVID records to complete a record-setting fall and now recovery. We'll talk about that here in a minute. Apple becomes the first $2 trillion company, partly as a result of that incredible recovery. And sales of previously owned homes jumped 24.7% to a seasonally adjusted annual rate of 5.86 million. That's the strongest monthly gain ever recorded since statistics were first collected in 1968. Here you see a picture of kind of that decline and recovery. We're looking at three different parts of the U.S. market: U.S. large companies in blue, the S&P 500, and then U.S. small companies and U.S. value companies in red and orange. You can see there that while all those stocks and all those companies went down precipitously at the beginning of the COVID outbreak, they have recovered, though the U.S. large company market has recovered faster and more completely so far than the small companies and value companies. The thing about the fall and the recovery that's been most striking is the speed. It took only 23 trading days for the S&P 500 to fall 34%. That was a record in terms of speed. Then it took 103 trading days for it to completely recover to its pre-fall high. That is also a record. So historically fast on the way down and historically fast in the recovery. I wonder, does speed tell us anything about the market, about the economy, and really does it tell us anything about our expectations and what's coming next? Possibly it's a little bit disorienting to see speed like that. I think one of the things that we're experiencing as a result of this particular crisis, if you will, is something that I'd like to call aseasonality. Aseasonality means experiencing the passing of time without experiencing the changing of seasons. The Kramer household, this is the first fall with no kids in school in 26 years. We also don't have a job tied to the school calendar. So our sense of the change of seasons based on school years is really different this year. I'd like to know that you think about, how do you mark the passage of time in your household? For many of you, the spring semester of 2020 never really ended, and summer really never started. It was the first of many time warps associated with COVID-19. So think about all the changes this year that are causing a disconnection with the way you experience seasons and kind of the tempo of your life. What marks the changing of seasons for you, the regular passing of time? For some, it's baseball. A picture of Wrigley Field here talks a little bit about the change in Major League Baseball season, which normally starts around April, didn't start till the end of July or August. And certainly from that picture, we see tens of thousands of people in a stadium that right now is empty when a baseball game is played. The same thing with NCAA basketball. NBA basketball lost their sense of rhythm. For those of us who love to go to summer movie blockbusters or summer outdoor concerts, those aren't happening as well. They kind of mark the passage of time for us also. And certainly summer vacations and travel just don't feel the same. You see a picture of a beach here with lots and lots of people. That's not the norm this summer for many of us. This disruption of time, our sense of rhythm, may be causing an underlying sense of impatience. We want this to be over. We want to get back to normal. So how does this disruption compare to some other ones? Well, let's look at some major ones. And World War II is more than a distant memory for most of us. More and more of us have no actual experience or memory of this calamitous event. But it went for 45 months, from December of 1941 to September of 1945. Pretty long, pretty calamitous. A lot of change as a result of that disruption. The 2000 dot-com bubble is closer to home for us. If you were a NASDAQ investor, the market to go through its peak to trough to full recovery took 180 months. March of 2000 through March of 2015 was the peak to trough to recovery. The S&P 500 was a little bit shorter, only 74 months from its peak to trough to full recovery. Closer to home yet, the great financial crisis. We kind of are more familiar with that one. 54 months from peak to trough to full recovery in stock market. And then the one we're in right now, COVID-19. Well, we reached our high of February 18th of 2020. We regained that high on the S&P, at least, on August 18th, only 7 months. We are only 7 months into this COVID-19 experience. It's traumatic, and I don't mean to make light of the life and death nature of the virus, but again, it's only been 7 months, and in terms of historical disruptions, relatively short. But it might not feel that way while we're in it. Why is that? Well, there's a lot of biases that work against good judgment and clear thinking. Before the pandemic, a market disruption lasting only 7 months or a disruption like a war lasting less than 18 months would maybe seem tolerable. Bad, certainly, but ones that you would expect to get through. But in the midst of one like COVID-19, our actual patience is severely taxed in ways we couldn't anticipate. The daily global new case numbers and deaths around the virus, they just compound in our imaginations. Though statistically relatively small at less than 0.5% in terms of the global population that actually has had the virus, there's something called the denominator bias. And when we put those percentages in terms of people, 22.4 million cases out of 7.8 billion people, the numbers begin to sound really big, in part because both numbers are so hard to visualize. Our unconscious biases can make the news that's most available to us and our own most recent experience very convincing that this is far worse or more disruptive than anything else in history, which of course wouldn't be true just looking at those previous disruptions in terms of markets and economics. Everything seems like a bigger deal when we're in the midst of it. In prospect, we underestimate the sense of disruption, and afterwards often we'll forget how bad we felt and maybe become a little bit overconfident that the next time it won't feel so bad. Will we have a vaccine by February? I don't really know. Are we getting closer? It certainly seems so. But if I told you 6 months ago that we'd be able to develop effective vaccines and treatments in less than a year for a global pandemic of this scale, I think many of us would have taken that as very good news. That was before the outbreaks and the shutdowns. So what does all this have to do with good investment results? Well, historically, patience has been an advantage in successful long-term investing, as well as good judgment generally. Patience is still a virtue, and as Warren Buffett, a very famous investor, quipped, "My favorite holding period is forever." That's kind of the ultimate statement of patience. Historically, COVID-19 has been a short, albeit different disruption to markets and the economy. Even more so, though, I think, to the cadence of our lives. Sometimes we just need to be reminded of not only how different this experience is, but also how historically short it has been. Our seasons will likely come back soon enough, but until then, you might want to give yourself a break if you're feeling a bit impatient or out of sorts. And try not to be too quick to take an investment action based on those hidden biases that time and patience might make you regret. Because as our quote for today says, fortunately for serious minds, a bias recognized is a bias sterilized. If you'd like to contact Foster Group and have a conversation about your investments or financial plans, here's some places where you can get a hold of us. As always, if you want to share this with your friends, we'd love that too. But until then, we hope you have a great couple weeks and we'll see you soon. Thanks.